You're stacking up SCHD shares in your portfolio, and suddenly everyone is hyping DGRO, or maybe the opposite. So now you're stuck with one question. Do you switch or stay put? Today, we're breaking this down the right way, clearly, simply, and without noise. By the end of this video, we'll run a full 20-year projection for both ETFs using the MoneySketch tool, a model that factors in dividend tax, expense ratios, inflation, and Monte Carlo percentiles. So the results you hear reflect real-life behavior, not motivational guesses. Every number in this breakdown comes directly from the latest official fact sheets and trusted financial sources only. First up, the Defender, SCHD. This isn't just a basket of stocks, it's a strict filter. It tracks the Dow Jones US Dividend 100 Index, which means it kicks out the weak links. To get in here, a company needs a 10-year history of paying dividends. But that's just the entry fee. SCHD then ranks them by cash flow to debt and return on equity. It's basically asking, is this company a fortress? When it comes to holdings, you are looking at roughly 100 companies in total. But notice the concentration. The top 10 make up about 40% of the entire fund. You won't find much flashy tech here. You get financials, healthcare, and consumer staples. We are talking about companies that make money while you sleep. Top 10 includes AbbVie, Home Depot, and Cisco Systems. Let's look at the DNA. Inception, 2011. Morningstar rating, 3 stars. Expense ratio, a tiny 0.06%. Dividends frequency, it pays you quarterly. But here is the data for our simulation. We locked in a 10 years price CAGR of 8.1%. And the real weapon? The dividend yield, which is 3.87%. with a massive 10-year dividend per share CAGR of 10.43%. It's the classic value play, low cost, high defense. Now, meet the challenger, DGRO. While SCHD plays defense, DGRO plays offense. It tracks the core dividend growth index, but just like SCHD, it has a strict velvet rope. To get in, a company must have 5 years of uninterrupted dividend growth. But here is the genius part. DGRO caps the payout ratio at 75% to ensure the dividend is safe. And crucially, it bans the top 10% highest-yielding stocks. Why? To filter out yield traps. Companies paying high dividends only because their stock price is crashing. Because of this growth focus, DGRO is massive. It holds 398 companies. That is roughly 4 times the diversification of SCHD. And look at the top names. You get Apple, Microsoft, Johnson & Johnson, and JP Morgan Chase. This gives you exposure to tech and growth sectors that SCHD often ignores. Let's look at the DNA. Inception, 2014. Morningstar rating, a strong 4 stars. Expense ratio, 0.08%. Dividend frequency, quarterly. But here is the fuel for our simulation. We use the 10-year price CAGR of 10.48%. That is significantly higher price appreciation. The trade-off? Dividend yield starts lower at 1.98%, but it's backed by a dividend per share CAGR of 8.91%. It's the growth play, broader reach and faster acceleration. Now, it is time to check for redundancy. You might think, they're both dividend funds, so they must own the same stocks, right? Wrong. This Venn diagram tells a different story. The overlap by weight is only 18%. Out of hundreds of companies, they only share 33 names. The few they do agree on are the absolute giants: AbbVie, Coca-Cola, and Merck. But outside of that small intersection, they are completely different portfolios. Owning both isn't doubling up, it's diversifying. Now, let's look at the scoreboard for the last 10 years. First, price return. This is just the stock price going up. Because DGRO leans into growth sectors like tech, it crushed this metric. DGRO is up 177.08%, while SCHD trails behind at 117.10%. But that's not the whole story. You are a dividend investor. You don't just watch the price, you get paid. So we switch to total return. This metric assumes you took every single dividend check and immediately bought more shares. When we add that snowball effect, the numbers jump massively. SCHD surges to 205.11%, but DGRO still holds the lead, sitting at a massive 250.37%. The last decade belonged to growth, but will the next 20 years look the same? Before we fire up our own 20-year engine, let's check the pulse on Wall Street. What do the pros see for the next 12 months? First, SCHD. Based on 99 top analysts, the consensus is a moderate buy. The average target price sits at $30.90. That implies a solid upside of 12.85%. Now, DGRO. The coverage here is massive. We are talking about 398 top analysts tracking this fund. They also rate it a moderate buy, with an average target of $78.18. The upside? Almost identical, at 13.11%. The pros agree on two things. 1, both funds are undervalued. And 2, it is a dead heat. Wall Street is looking at the next year, but we need to look at the next 20 years. Let's run the simulation. All right, SCHD Engine. We are starting with a lump sum of $20,000. No monthly contributions, just pure compounding. Look at the precision here. We didn't just guess. We locked in the exact current metrics. A dividend yield of 3.87%. Dividend per share CAGR of 10.43%. And a price return CAGR of 8.10%. We even factored in a 15% tax rate and the 0.06% expense ratio. So the results we get are real-life scenario. Fast forward to year 20. That $20,000 grew into an ending balance of $210,437. Look at the breakdown. Around $121,000 came from price appreciation. But the real engine? SCHD delivered $69,069 in cumulative dividends. And your passive income? By year 20, you are generating $9,757 a year, or $813 every single month. But $1 in 20 years isn't worth $1 today. So we activated inflation mode using the latest CPI of 2.26%. In real purchasing power, your ending balance is $134,588. And that annual income feels like $6,291. Finally, we stress-tested the volatility. Based on SCHD's history, the median outcome is actually lower, at $180,669. The nightmare scenario? The bottom 5th percentile drops you to around $68,000. But the dream scenario? The top 95th percentile shoots that same $20,000 all the way to $478,827. Now, let's run the engine for DGRO. Same $20,000 start, same rules. But look at how the DNA changes in the input fields. We entered the dividend yield of 1.98%, much lower than SCHD. The dividend per share CAGR is running at 8.91%, and price return CAGR of 10.48%. Expense ratio is slightly higher at 0.08%. Fast forward 20 years. The ending balance is $192,824. Wait a minute. That is lower than SCHD. Why? Look at the breakdown. The price return is massive at $151,578. The growth engine worked, but the cumulative dividends were only $21,247. The income stream tells the real story. By year 20, you are only making $2,311 a year. That is just $193 a month, compared to SCHD's $813. In real purchasing power, that ending balance drops to $123,324, and the annual income is just $1,490. But here is where DGRO fights back. Because it has higher volatility, Monte Carlo telling us that upside potential is wilder. The median outcome sits at $202,129. The bottom 5th percentile is safe at $79,591. But look at the top 95th percentile. If the bull market rages, DGRO shoots all the way up to $513,327, beating SCHD's best-case scenario. So, back to the original question. If you own SCHD, should you switch to DGRO or vice versa? First, let's be clear. Both of these are for dividend-based portfolios. If you are chasing pure hypergrowth like the Nasdaq, neither of these is your play. You are in the wrong room. But if you want cash flow and reliability, here is the split. For maximum passive income to pay the bills right now, SCHD is your winner. It delivered 4 times the monthly income of DGRO in our model. It is the ultimate shield. But if you have a longer timeline and you want to prioritize total wealth over immediate cash, DGRO has the higher ceiling. Its top-tier Monte Carlo outcome beat SCHD by over $30,000. And remember the overlap? It's only 18%. So the smartest move might not be switching at all. It might be owning both. This was our simulation, but your portfolio is unique. You can run these exact 40-year projections for your own stocks using the MoneySketchTV tool. It is the same engine we used in this video. Grab it at the link in the description below. Now, I need your input. We have the engine ready. What topic should we discuss next? Drop your requests in the comments. Let's build the show together. Ciao!